Hi, I thought we'd put together this little video just to give you a quick summary of our take on what occurred in Tuesday night's budget. No, I wasn't in the budget lockup, and no, I didn't spend 60 minutes of my precious time watching the budget speech, but I have spent a couple of days having a look through the material that's been sent out to us, and this will give you a quick summary of some of the things which you need to be thinking about as a consequence of the changes that were made in the budget. Now, the main area of impact as far as the budget is concerned has been in the area of superannuation. But there's a lot of confusion around about the measures, the timing of their introduction and when things actually happen. So hopefully I'll be able to give you some additional information that will be useful to you when you're considering the impact on your circumstances. So the first of the measures, which came into effect on budget night at 7:30 in fact precisely, was the lifetime limit, which has now been introduced in respect of non-concessional contributions to superannuation. Now, this is a pretty important sort of a measure. Previously, we had a situation where we could make $180,000 per annum contribution to super, or $540,000 over a rolling 3-year period. This has now changed completely. We now have a lifetime cap for super contributions, that is non-concessional contributions, those which are made after tax, which is now at $500,000 for your entire life. Now, this goes back to 2007, when the tax office believes that it has good and accurate records of the super contributions which everyone has made. So what does this mean? Well, really, if you've already made a contribution of $500,000 or more in a non-concessional sense, it means that you really can't make any more. If you've already embarked upon making non-concessional contributions to super, then the maximum you'll be able to make in your lifetime is the difference between that which you've already made and $500,000. So this is a very important change, and one which we need to be careful of. So that measure took effect immediately on budget night. Now, there are a couple of measures which take effect on the 1st of July 2016. The first of these is that the 30% personal tax rate, which currently comes into play for incomes in excess of $80,000, will now come into play for incomes in excess of $87,000. And this is an aim to attempt on the part of the government to reduce bracket creep. The second impact, which comes into play on the 1st of July 2016, is that for small businesses which operate via a company structure, the company tax rate will fall from the present 30% to 27.5%, on the assumption that the company concerned has a turnover of less than $10 million. The aim, which was outlined in the budget papers, was to increase this threshold to a higher rate over time, and also to further cut the company tax rate down to around about 25% over the coming years. So the most important measures in respect of superannuation and other things come into effect on the 1st of July 2017. You'll recall that the present concessional cap for superannuation contributions, that is, those contributions which are made by your employer or those which you salary sacrifice, is presently $30,000 for those people who are aged less than 50 and $35,000 for those people who are aged more than 50. The concessional contribution cap has been reduced to $25,000 for all Australians. This is going to have a fairly major impact on a lot of people's circumstances, particularly those who are attempting to maximise their superannuation savings by making the maximum contribution into superannuation that they're entitled to do. It will also have an impact on those people who are running transition to retirement pensions. So from 1 July 2017, you need to get some advice to make sure that you're not actually exceeding those contribution caps. A second change which has occurred around superannuation contributions from July 2017 is that you are now eligible to contribute to superannuation if you're between the ages of 65 and 74, whether you're working or you're not. Presently, there's a work test which says that you must be working for 40 hours or more in the month in which you make those contributions to be eligible to contribute. All Australians between the age of 65 and 74 will be able to contribute to superannuation in a concessional way. So from 1 July 2017, a further change which has occurred is that all Australians are now entitled to make a tax deduction claim for contributions which they make to superannuation up to the amount of the new concessional cap. Under the older rules, if you were receiving superannuation support by the way of superannuation guarantee support from your employer, you were not eligible to make a contribution and claim a tax deduction for it, except in particular circumstances. Now you'll be able to claim a tax deduction for all contributions made up to the amount of the concessional cap, regardless of what superannuation guarantee support you're receiving from your employer. There have also been changes which will come into force in July 2017 in respect of the amounts of superannuation which can be transferred into pension phase. That is, the superannuation balance which can be transferred to a pension account. The maximum amount that you'll be able to now transfer to pension will be $1.6 million as from the 1st of July 2017. So if we're in a situation where we're planning to make a higher transfer into pension phase, then we'll need to do so before 1 July 2017, and that will give us some planning opportunities. This measure has been introduced as of course, superannuation assets which are used to pay pensions are concessionally taxed. That is the best tax rate in the world, which is 0% for those assets which are used to pay pensions. And the government's introduced a limit on the amount of pensions which can be created in order to preserve the revenue and to remove some of that concession. Transition to retirement pension changes also come into place on the 1st of July 2017. Presently, those transition to retirement pensions which can commence once you've reached preservation age, which depending on your age could be somewhere between 55 and 60, will now be taxed at 15%. So that is, if you're using income from your superannuation fund to pay yourself a pension in order to supplement your income, right now the income from those assets used to fund that pension are not taxed at all. This will now be at 15%, the same as any other superannuation assets, as from 1 July 2017. And this is going to have a significant impact on the effectiveness of the transition to retirement strategy for those people who are still working. Now, there were a couple of things within the budget which were surprising from some of the predictors of these things which didn't actually occur, and it's important to make note of those here. The first one is that there were no changes made to the negative gearing arrangements. That is, those taxpayers who invest in assets which make a loss by way of real estate or whether borrowing to invest can continue to claim a tax deduction for the loss that they so make. And it was expected by some that this would be changed as from budget night, but this simply didn't occur. The second thing which was widely expected but didn't actually occur in the budget is that there have been no real changes to the age pension rules. There are significant changes to age pension entitlement rules which come into force on the 1st of January 2017 and were previously legislated, and these will continue to come into force, but there have been no additional changes made. So there it is. Hopefully I've given you a quick summary of some of the things which you need to be thinking about when you're considering the impact of the 2017 budget on your financial affairs. I hope you found the material useful. If you do want to discuss anything in relation to this video or any other matters as to how they specifically affect your circumstances, don't hesitate to give us a call. There are a few other things which will come into place, and we also need to realise that a lot of the stuff that we get in budget papers, etc., doesn't actually come into force until we receive legislation, and very often the devil is in the detail. The other thing I should also caution is that in our current political environment with a looming election, it may be that some of these measures never come into force at all. So we'll have to keep an eye out. If anything important happens, of course, we'll let you know. Look forward to talking to you again soon.